Welcome to the Daily Drawdown, where AI spend, market concentration, and cable upheaval are moving prices. A few big themes are colliding at once. AI demand is still pulling capital forward, but the plumbing around it is getting tighter. At the same time, old cash flow machines like cable are being repriced lower, and markets are getting more sensitive to leverage, concentration, and policy noise. Comcast split is one of the clearest examples of how the market's changed its mind about legacy broadband. The company is separating NBC Universal from the cable and broadband business, carving out about a fifth of revenue and framing it as a value-unlocking move, not an immediate sale. What matters is the multiple reset. Commentary around the deal says the cable side's implied value has dropped from roughly $200 billion years ago to closer to $80 billion now, while the media assets may actually command a better valuation once they stand alone. That tells you where investors think growth and strategic value sit now, and it's no longer automatically in the pipe network. There's already speculation that this could set up future consolidation with Charter or another cable player, but that path runs straight into antitrust risk. Regulators killed Comcast's Time Warner cable bid before, and any big combination would likely take a year or more to work through approvals and tax structure. The bigger immediate pressure is competitive. Fixed wireless from T-Mobile and Verizon has been stronger than incumbents expected, and Starlink is increasingly treated as a real long-term threat to household broadband share. If Starlink can scale from around 4 million US subscribers toward a much bigger base over the next several years, and if it pairs satellite with mobile or cable partnerships, that keeps pressure on pricing, retention, and valuations across the cable group. SpaceX is showing up in markets in 3 different ways at once: index flows, credit risk, and telecom competition. On the flow side, fast-tracked inclusion in the NASDAQ 100 and additions to Russell indexes should force passive buying. That can create near-term price support whether or not fundamentals change that week. On the financing side, the reported $25 billion bond package got attention because it's a very large debt load for a non-profitable BBB-rated tech name, and long-end spreads opened around 203 basis points. That matters beyond one issuer. If high-growth tech keeps leaning on debt markets this aggressively, the risk is that credit looks fine until sentiment turns, and then leverage suddenly becomes everybody's problem. Strategically, SpaceX is also deepening the satellite telecom fight through moves like Iridium, while Amazon, Globalstar, and others push their own positions. The battlegrounds are spectrum, aviation, and maritime reliability, defense links, and mobile partnerships. Watch whether satellite players become partners to incumbents or direct substitutes. That decision will shape who owns the customer relationship. The AI build-out still looks enormous, with warnings from the BIS and others that hyperscaler capex could run into the hundreds of billions or even top $1 trillion over the next year or two. The key shift is that this story is no longer just about demand, it's about constraints. Memory is taking a much larger share of AI capex in some forecasts, rising from roughly 8% to as much as 48% by 2027. That pushes price pressure deeper into the component stack and makes supply chain bottlenecks more important than headline server demand. We're already seeing usage friction. Google reportedly capped Gemini access for partners because compute demand was overwhelming capacity, and AI vendors are moving away from flat, all-you-can-eat pricing toward per-token billing. That's a sign the market is trying to ration scarce compute through price. Then there are the physical constraints: power access, permitting, labor, construction delays, and even helium shortages that hit semiconductor fabs. Small changes in demand can create outsized delays when every input is tight. Some operators are responding with modular, repeatable build models and smaller teams to speed rollout outside the most congested regions. That's worth watching, because execution speed may become as valuable as chip access. Memory has become one of the purest ways to play the AI spend cycle, and it's getting crowded fast. Spot prices and names like Micron, Samsung, SK Hynix, and Western Digital have surged, while a new DRAM-focused ETF reportedly gathered more than $24 billion in weeks. That kind of flow can reinforce momentum, but it can also distort it. The valuation argument is straightforward. Memory names are still discussed at single-digit multiples, around 8 to 9 times in some cases, while CPU and broader AI infrastructure names trade far richer. Bulls say memory is still underpriced relative to its earnings power in this cycle. The risk is concentration and reflexivity. Commentators flagged heavy short interest, squeeze risk, and the possibility that one name like Micron becomes too large a share of earnings expectations and portfolio positioning. Add in geopolitical supply noise like pressure around Chinese supplier access and large Korean semiconductor investment plans, and you have a market that can stay tight and volatile at the same time. The Mag 7 debate is getting more balanced, but concentration is still the central market fact. Top S&P names now make up more than 40% of the index, which means index performance is still being driven by a very small group. Supporters argue the premium isn't that extreme relative to the broader market, and earnings growth still justifies it. Skeptics are focused on capex and margins. If AI spending stays this high and monetization lags, free cash flow takes the hit, even if revenue keeps growing. At the same time, there are signs breadth is improving. Equal weight has outperformed at points, the Russell 2000 has surged, and rebalancing flows are helping smaller names and value sectors catch some oxygen. That doesn't mean the leadership has broken. It means the market may be shifting from one trade dominance toward a more mixed tape, where sector selection matters more. Policy is part of that backdrop. Markets have been assigning real odds to a near-term Fed hike, even with mixed guidance. And sticky core services inflation keeps the Fed cautious. Add divergent central bank moves globally and fresh legal noise around agency independence, and the result is a market that can swing hard on macro headlines even while equity leadership stays narrow. The biggest systemic watchpoint is leverage. Reported U.S. margin debt is up about 54% year over year to roughly $1.4 trillion. That's the kind of number that doesn't hurt on the way up, but it can make every sell-off sharper if positioning starts to unwind. Consumer credit growth also remains strong, with uneven stress underneath it. Younger renters have looked more resilient in some data, but credit card delinquencies are rising, so the consumer picture is holding, not clean. A few quieter signals matter here too. Healthcare has been attracting active money, and the FDA's new pre-check pilot could shorten manufacturing approval timelines by as much as 14 months for participating companies, which is a real operational tailwind. In commodities, helium shortages are a practical constraint on chip production, and gold keeps coming up as a hedge against policy error and market stress. In oil, the notable thing is what didn't happen. Despite tension around Iran and Hormuz, crude hasn't held a major risk premium, though rerouting of shipping looks more structural and could matter more over time than the short-term price response. That's the brief for today. AI demand is still strong, but constraints, leverage, and competition are starting to matter as much as the headline growth story. You're listening to the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.